Morning, everybody. Welcome to the morning market briefing, Wednesday, March 23rd, 2022. Hope you are doing well. We will open up probably where you would expect us to open up, talking Russia and Ukraine. Things continuing to get a little bit uglier, especially in Mariupol. The mayor says that previously there were 2 planes flying around, now we're up to 5. It's really just starting to get uglier and uglier. I mean, even just Tom, we've talked about how weird it is following a war on Twitter, even just the images there. Continue to just see kind of the decimation of the scenery there, and the general infrastructure continues to suffer. So it's not a pretty sight. There's only about 100,000 people left in that town, though, but continuing to be ugly. Zelensky is continuing to make efforts to appeal to his allies. Ben, where do we stand in terms of potential support, sanctions, all of those things?
That's the big debate. So Zelensky is trying to make the push preemptively that there's a bunch of meetings happening this week in Europe, but President Biden's over there. He's going to be meeting with NATO. He's going to be at the G7 meeting. There's an EU meeting as well. And then Biden's also going to be meeting with the Polish president. The NATO summit and the G7 meeting are tomorrow, so everyone's kind of getting out their opening salvos today. The Ukraine presidential advisor says that Ukraine is hoping that there's going to be some more sanctions coming at NATO and the EU, but it doesn't seem like they're really ready for that. The German government spokesperson said that no big new sanctions package is expected at the EU summit on Russia. So for as much as Zelensky's trying to create new sanctions and new aid, it seems like it may be more words of support more than actions of support. But we'll see all that tomorrow. NATO is meeting at that time. G7 is meeting at that time. And certainly there's a lot of pressure to get this done and get some aid to Ukraine. There was a Ukrainian expert who came on and said that the war is essentially unwinnable for either side, and therefore it needs to be settled with peace talks. They think that the active phase of the war will be over by the end of April, but that's again coming from Ukrainian sources, so who knows what Putin's plans actually are. For its part, Germany doesn't plan to move away from any Russian oil or gas, saying that would just really crater their economy.
I mean, I kind of agree with the Ukrainian assertion that this is just not a winnable war. I mean, I felt like the first week it seemed like, hey, this thing's going to move pretty quickly. Thereafter, it felt like, hey, we are probably going to see a little bit of a more concerted effort from the Russian side. We just haven't. I mean, it just continues to drag on. It's certainly a war of attrition, and it kind of makes you wonder, in the event that Russia prevails and the only conflict is, militaristic, there is no peace resolution. What are they going to be left with at this rate? Tom, I don't know if you have any just high-level thoughts on the war at this juncture.
Yeah, I really don't have a lot to add. I just don't really know what the end game is at this point. I don't think anybody does. So it's just going to keep being a general malaise, I think, on the markets until we have some sort of break one way or the other.
Yeah. Speaking of the market, bond market, tough times, man. Talk to us about what's going on, what you're keeping an eye on, and how you're kind of filtering through our investment process.
So yesterday, with the market being up, we officially crossed into the territory where the bond market is now officially underperforming the stock market for the year by about 1%. The Barclays aggregate bond index is down about 6.5%. The Barclays Muni aggregate, which is the one we're probably most closely associated with, is down about 5.5%. And it's just a very tough environment, particularly with Jay Powell, talking about getting more aggressive. It's just a very, very tough environment to buy bonds. We took a lot of steps in 2020 and 2021 to prepare for rising interest rates. We did a lot of work buying things like step coupon bonds and floating rate municipals, which have done very well, but there's such a small portion of the bond market that, the level of exposure that any one client really should have is relatively limited. And the bond market at large has sold off quite a bit, but the areas that have sold off the hardest are the 1, 2, and 3-year treasury. And so when you think about rising interest rates, typically the defensive move is I'm going to lower my duration, which is my interest rate sensitivity, down to 3 or 4 years. But the problem is that sensitivity is pegged to a comparable treasury. And so if you say, hey, I'm going to get short here, I'm going to have an average bond life about 3 years, and then the 3-year treasury sells off the worst in 48 years, suddenly you're being very exposed to that piece of the bond market. And I expect that to reverse. I think there's going to be some steepening in the yield curve towards the back half of the year, particularly as inflation starts to come down on a regular glide path. But it's been very tough because, we've talked a lot about how the expectation was that interest rate risk was going to be the big one, and we're going to get short, and that credit risk was not going to be as significant it has been, because we've seen so many companies go bankrupt, and that continues to be true. I mean, the bond market is down quite a bit, but this morning we had upgrades on over 100 QSIPs, so individual names, be it Reno, Nevada, or Philadelphia, or Cleveland. The New Orleans airport was upgraded. These are all bonds we have exposure to, and they're becoming more creditworthy. They're getting cleaner. The odds of default are going down, but prices are also going down. And so that thesis remains true, which is that credit quality is not going to be the problem this year. It's duration. The issue is that if you've got very, very short duration, you are getting punished the most, despite having made the correct choice in a rising interest rate environment. It's just a function of the yield curve flattening and not steepening. So I think the opportunities available are, we can basically buy any bonds we want to fill in a ladder, because most bonds are yielding about the same. We can be very flexible with what we need. We can fill in holes where we haven't been able to buy bonds, and we can continue to buy short and lean into the big selling that we've seen on the short end as well. But I would say that it's just a very tough environment, and the more hikes we get, the tougher it's going to get. We need inflation to come down. We need a little bit of clarity on Ukraine, I think, and going forward, there's probably going to be a shift in where we're buying. Corporates are finally becoming reasonable, and so the shift is going to be into different types of bonds, different structures, away from what we've had to do the last couple of years in order to maximize bond portfolios in low interest rate environments. Now we've got to switch to what happens if we're in an active bond sell-off. How do we structure that? And so it's going to be a little bit of a different flavor going forward. If that makes any sense to anyone. I don't know how much anybody really cares about bonds.
No, Tom, I think one thing that I'd be curious, maybe to kind of bring all this home, I feel like we talk a little bit on this call about kind of the theme. We're not market timers in terms of, on the equity side. We don't want to just say, hey, this is the bottom. But I certainly think, thematically, as we're talking to clients, a common question for clients is, we have cash. Is this a good time? Is this a good time potentially to be going in? How would you kind of characterize the bond market right now, kind of through that lens? Because I think, one thing we don't want to overemphasize is kind of short-term performance of fixed income. We are primarily holding to maturity. We want to see returns, but people, thinking about, hey, is it a time to be actually moving in? What are your thoughts? Like, how would you what time period would you compare this to on the actual side of potentially picking up fixed income? Does that make sense?
Yes, I think it's important to remember, and even though bond prices go down, when you look at prices going down on your bonds, it doesn't really matter if you're holding the bonds to maturity, because ultimately you're going to get par back. And so really what you're looking at is that you pay a certain premium for a bond, and you're going to get more than that back in income. But what happens is if the premium goes down faster than you're receiving that income, you end up underwater. And so as you go along in time, eventually that is going to go back to par, and you're going to get those coupons, and then this amount of money is going to be the same no matter where these both went in that time period. So that's an advantage we have over mutual funds, which are just getting absolutely slaughtered, because once you sell, you're out and you take that loss and you're gone, and you don't own those bonds, and it doesn't matter if you sold or somebody else sold. You're subject to that selling. So I would keep that in mind. So no matter what, especially with improving credit, we're going to make that money, even if it's going to be a little bit of time before we get back above water on bonds. But the important thing too is that we always have bonds coming due. We structure the portfolios to always have money coming due. And so, as the first bond to drop off and turn back into cash goes away, we're now reinvesting it now at much higher rates, and that's going to continue to happen. So as the bond portfolio rolls down the yield curve, we're taking the opportunity. And so it's kind of like a sine wave. You've got bonds with different eras coming through your bond portfolio, and they're not all going to be yielding the same. And if you can average that out across time, we're going to be in good shape, because we have bonds we bought 4 or 5 years ago at much higher rates. We have bonds we bought in March 2020 at the highest rates, in the history of the bond market, because it basically just went to zero overnight, that are still way up, and we're still going to be yielding 5-6% on those for the foreseeable future. And so I think it's important to remember that even though the prices are depressed, there's always opportunities in bonds. We can always find stuff that's going to yield well. It's just a function of looking at different structures and different shapes of bonds.
Cool. Awesome. Thanks, Tom. Ben, got earnings from Adobe, also from General Mills. Talk us through what we're kind of starting to see as we're looking at those numbers, at their reports, at their commentary, all that good stuff.
Yeah, I think Adobe was a tough one. This is the second quarter in a row where they've had a disappointing guidance. And they did strike an optimistic tone for the second half of the fiscal year, which begins, I guess, in June. So they did strike an optimistic tone there. However, I was a little bit disappointed. I was hoping for more out of their guidance for the May quarter. So we're continuing to evaluate that. We do own Adobe. It's a relatively small position for us. They have a fairly entrenched market, but the question for them is, can they sustain this top line growth? A lot of their disappointment did come from avoiding business out of Russia and Ukraine. And so I think that definitely played a role in the guidance that they provided. But it's just tough for these companies in software right now. If you don't have the numbers, the market's not going to look at you very kindly. And then General Mills also reported earnings. And so one of the things that I think has been a common theme is that these cost pressures and this cost inflation is really killing a lot of manufacturers, including food manufacturers. But that's not the case for General Mills. In fact, General Mills's gross margin is actually performing quite well. It beat estimates. Their pricing was up 7% overall, but in North America retail, it was up 9 percentage points. And in North America food service, it was up 18 percentage points. They also have a pet business where they included pricing of 13 percentage points. So General Mills really passing through more than all of its cost inflation. And that's something that we're seeing throughout the industry. There's just been this lid that's been lifted on a lot of companies' ability to price and how aggressive they're being on that. And so they actually raised guidance for the year, and they see that things are going quite well for them. And they expect to drive strong growth in the next quarter and expect their plans and positive momentum to continue for the next fiscal year. So good quarter out of General Mills. Again, it's all predicated on pricing because volume was actually down.
Good deal. Thanks, Ben. Thanks, Tom. We're going to wrap it up there. Just for context, right now, S&P futures are down about 50 basis points, so about 0.5%. Dow futures down about 40. NASDAQ futures down about 75. We will see what happens. We'll be back tomorrow morning at 8:30, and we'll talk to you then.